right, I cut that video off. I just going to try to make it a kind of seamless. So let's move on to the bottom of page 165 and let's talk about diversification a little bit. And you can read the little quote there: money's like manure left in a pile, it stinks, and spread it around and it'll grow things. So we don't want to put all of our money in one spot, one stock, one mutual fund. I mean, are you with me? So we're going to diversify. And, as you move on through life, you could diversify. You might get into real estate. Some of you may have some rental property one day. My wife and I, we've done rental property, still have a rental property um, in the stock market. So you can do a variety of things. You could be diversified in the stock market. You could have 5 or 10 stocks, and they're in different areas. One might be in energy, one might be in tech, one might be in retail, one might be in healthcare. I mean, you could diversify. All right. So, and you'll see how that plays out in the value of diversification. But diversification is a risk management technique where you mix a variety of investments in your portfolio. All right. And some of you may go work for a company, and you don't want to put all your investments into one company, because if the company goes under, you're kind of left out in the cold. So you always want to diversify. So that's where we're going to go. All right. Not going to put all of our eggs in one basket, as the saying goes. Now on page 166. Um, Obviously, you need to make money. So you're not looking for a 2% return. You're not going to go buy a bunch of CDs or something where you can get a couple percent. You really need to make 6, 7, 8, 10% a year. Now the stock market, since it began, and we're living in these times of economic turmoil. I get that, uh, but historically, the stock market has returned over 11%, close to 12% a year. Now, does that mean it'll do it for the next 10 years on average? No. I'm just saying historical averages. So, once again, you got to keep all that in mind. We're thinking long term. We're not investing in the stock market to try and grow money over the next 2 or 3 years. That's not the vehicle you take. If you're saving up to buy a car for education and you need the money in less than 5 years, we're not going to the stock market because it fluctuates too much. Now that's more like 10 years, 20 years, then you're more likely to hit the averages. All right. But when you take into account inflation and taxes, because you do have to pay taxes when you take money out of your retirement fund. However, we'll get to the Roth IRA, except you are limited into how much you can invest a year. However, if you will go back and look at the chart on page 40, and I'm just going to use round numbers. These are not precise. You can invest more than 5,000 a year in a Roth if you make that much money. And you can see that if you just did a Roth IRA from about age 20 and invested just 5,000 a year, now that money grows tax free. So when you take it out and you're 60, 65, you don't pay any taxes. And that is a great, great investment vehicle. All right. So I just want you to keep that in mind, but we want to try to get a pretty good return on our investments. Now, you'll see that in the first paragraph, virtually all investments, as the risk goes up, the potential return comes down. So, I mean, that's the name of the game. If it was 100% risk free, everybody would invest in it, but you probably wouldn't get a good rate of return, like a savings account. Can't lose your money. A CD can't lose your money. It's in the bank, and supposedly it's insured. Uh, so, but you get 0.5%, 1%. That's not a very good return. I mean, you're actually going to lose money. You'll you'll end the year up. If you made 1% and inflation was 2%, you're in the whole 1%. Okay, so we want to invest in things where there's a little bit of risk involved. All right. Well, liquidity refers to assets that can be easily bought or sold. Now, when discussing investments, liquidity is availability. So you have $1,000 in your savings account that is liquid. You can access that money right away. Now, as there is more liquidity, there is typically less return, and there's less return on a savings account. Now, for the most part, stocks are fairly liquid. There's always buyers and sellers, and your chances of getting a higher rate of return. Although recently there's been some stocks that it was hard to find buyers for, and then the price goes down even further. So, anyway, I don't want to spend too much time on that. All right, but you can see on the bottom of page 166 the power of diversification. So, look at the chart and just look at it real well, spend some time, think about it, try to understand it, and see the power of diversification. Now, if you were to stop right now, when we were to stop right now, and you were going to give advice to a friend on page 167, what would you say are the most important things to know about investing based on what we've talked about so far? And we've talked about things about risk reward, we've talked about diversification and so on. But we're going deeper. We're going to go with a little bit more. All right? But so far you've got you know enough right now that you could do pretty well. You think, no, I don't know anything yet. Okay, well, we're going to come back in the next video. We'll talk about the types of investments that are out there and that you can begin to invest in. All right?